Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Today, I wanted to go over some articles that I was reading. I really wanted to share it with everybody just because some of them I think are kind of cool. And, I'm not anti-EVs, I'm not anti-Tesla, but I do think that Tesla is priced very weirdly. Interest rates and the big boom and bubble, I think it's going to be very harsh on Tesla. So I have an article on Tesla. I've got some articles on oil prices and some other things. So I really wanted to touch into it. I know we got a lot of oil people on the channel, a lot of energy bulls, myself included, obviously. And we'll take a look at some of the articles to give you guys some other viewpoints rather than just mine. We can look at the data. The news articles, they don't really faze me. I'm like, I think in myself, I personally think that I'm ahead of the game here in terms of the articles. We kind of knew that this was coming. So knowing what we know on the channel, and you guys are probably figuring this out yourself if you've been on the channel for a while, like we're seeing things before they actually happen. And that's what you want to do when you're an investor, is you want to see things before they happen. The news comes out later after we've already positioned, and then it just gives you validation or confirmation that we're positioned correctly. So here we go. Let's look at the news. Let's see what people are talking about. It says Bank of America predicts Tesla's market share will collapse in the next few years. There's a bunch of new EV models hitting the market that could force Tesla's market share to plunge, the U.S. market share. In the United States, the bank is predicting 1 million EVs sold in 2022, 1.8 in 2023, and 3 million sold in 2024. That's a very good growth curve. That's why this morning's Bank of America note, wherein the bank suggests that Tesla's U.S. EV market share could drop to just 19% by 2024, and it's currently at like 66.3%. A massive obliteration of their market share. It says the bank says that a slew of new EV models hitting the market could force Tesla's U.S. market share to plunge from its current 69%. We've got that on the right-hand side, U.S. electric new vehicle registration share by brand. Right now, Tesla is dominating, but it is shrinking fast. And that projection has Tesla's market share in the United States market to shrink from 69% to 19% over just a 2-year time frame. Pretty impressive if that actually happens. Now we've got the tight physical crude market points to higher oil prices. A tight physical supply in crude markets could send oil prices even higher. Demand has proven to be more resilient to the effects of Omicron than many analysts had originally thought. With both physical and futures markets rallying, the increased geopolitical premium, market observers are looking towards the $100 mark for oil prices. That's what I thought. Triple-digit oil is in the works for the second quarter. Head of global commodities at Bank of America told Bloomberg last week, demand is recovering meaningfully while OPEC plus supply will start leveling off within the next 2 months. Noting that Russian supply will level off, and it will be only Saudi Arabia and the United Arab Emirates that can produce incremental barrels to add to the market. Tighter market, guys. The worst is yet to come for UK households as energy prices soar. Going back to the energy crisis, as the increasing ceiling on household power utility bills could throw millions into energy poverty. A second update in October could further raise power bills for UK consumers. Energy consultancy NEPSIS energy price cap could reach $3,200 in October. Then we've got on the right-hand side here, a copper crisis threatens the energy transition. So what I'm trying to paint the picture here is we have a very tight physical crude market. We've got energy prices that are already soaring from an electricity and heating standpoint in the UK. Then on top of it, our plan A of renewable energy has a copper crisis that threatens the energy transition. So I'm tying these articles together purposefully, if you want to see. It says global demand for copper is forecast to outstrip supply by more than 6 million tons by 2030. A combination of low investment, environmental resistance, ESG, and supply chain issues are set to send copper prices even higher. The supply shortage will almost certainly boost recycling levels as demand is only set to grow. And then we've got a chart here, the global outlook for primary copper demand and supply. It really starts to break apart about a year out from now. A year or two out, we're going to start seeing these larger shortages. One of the reasons is new copper resources continue to be discovered in Indonesia, in two names that I can't pronounce, in Democratic Republic of Congo, yet many remain undeveloped as potential mines can suffer from low ore grades and fiscal or political uncertainty in the host country can delay development. So that's what we're suffering from, low ore grades, which means more energy to get this stuff out. And the reason I'm kind of highlighting on this, and I'll pop in here 1 second, we're setting up a very weird scenario that I don't think we've ever seen in history before. And I'll talk about it at the end as well. But for this, what I want you to get out of it is low ore grades and then increased exponential use of energy. So just keep that in your mind. We've got, scrolling down here, could oil really reach $200 per barrel? It says Doug King, head of the Merchant Commodity Fund, enjoyed record returns last year, gaining 74% in 2021, blah, blah, blah. It says another boom year for oil right before the bust. But now King is expecting further gains in the price of oil, saying it could even reach $200 per barrel over the next 5 years. We believe in structural supply-side commodity inflation that most will not have ever seen, except for finding value. Okay, that's right. The highest since the 1970s. Only OPEC will react to price metrics, and they are undershooting every month. In practice, a lot less oil is making its way to the market. Its members are simply unable to return to pre-COVID levels of output. This is all down to a lack of investment. At least that's what they think. Goldman Sachs calls a 10-year commodity supercycle. According to the analysts, the oil markets are currently in a big deficit of 2% of global demand, with inventories about 5% below their 5-year moving average. He goes on to say that the financial setup offers even more support since fossil fuels remain out of favor with the investing universe, while ESG headwinds pose a major challenge for a sector that badly needs new investment if production is to keep up with demand. We've got this as my last one, and I think it's ludicrous, but it says White House ready to deploy tools for oil price control. Really? It says White House is ready to deploy tools to address oil price increase. Biden administration continues to work with oil producing countries and continues to monitor prices in the context of global economic growth. Go on to say, we continue to work with producer and consumer countries, and these steps have had real effects on prices, and ultimately tools continue to remain on the table for us to address prices. We will continue to monitor prices in the context of global economic growth and engage our OPEC Plus partners as appropriate, Horn also said. I do think that the idea that Russia and Saudi Arabia and other major producers are not going to pump more oil so people can have gasoline to get to and from work, for example, is not right. President Biden said in November, gas prices, of course, are based on global oil market. That oil market is controlled by a cartel. That cartel is OPEC, Energy Security Jennifer Granholm said in November. So that cartel has more say about what is going on. Well, that's what their opinion is. The thing that I really want to drive home here is they're pinning this, they're putting everything into like a corner, so to speak. So we've got our back in the corner, and we're saying we've got this world that's running on oil. And then they've got this futuristic idea, I'll call it, of a world that runs on renewables and non-fossil fuels. So we're in this corner. They don't want to invest in what works and what has sustained life for many, many years. The high energy return, oil and fossil fuels. And this stuff is coming into problems in the future, I think. I don't know if we have as much oil in the earth at flow rates that are, let's say, double than where we are today. If we're at 100 million barrels, could we go to a 200 million per barrel production? I doubt it. I don't even think we could hit 120 million barrels. So I think we're probably pretty close to peak oil is my guess. I don't exactly know, but I bet you if I were to kind of do a off-the-cuff bet, I would say we're getting closer to peak oil within 5-10 years, or even today. I don't know the exact timing, but we're getting closer. We are shutting down investment to it, which means the decline is going to be quite dramatic. On what's coming up, the decline could be quite dramatic. And if our option A of renewables doesn't work and we hit shortages of minerals, let's say copper that I covered in this article, where we could see very large deficits in copper, it's not setting up a scenario that I think is that great. And what I am I'm kind of feeling out that we could have a potential energy shortage, just like we're seeing in Europe, just like we're seeing in some of these other areas like Asia. And it could spread into the entire world as everything is interconnected. We're just a bunch of nodes that are all interconnected around this world. So if you start having energy crises in multiple areas, it's probably going to spread to the entire world as we go to other alternatives than what we're doing today. If natural gas goes short, we'll go to coal. If coal goes short, which we're seeing, we're going to go to oil. Oil is going to go short. Then we're going to try to run the renewables, but the renewables can't ramp up because we're hitting mineral shortages of a bunch of different minerals. And let me see if I've got one last thing that I can show you guys. There was a really good slide that I want to show you in the metal shortages, and here it is. This here is the metals in a net zero scenario. Current production rates of some important metals, including copper, are likely to be inadequate to satisfy future demand. This is the supply-demand ratio, energy and non-energy demand coverage. We've got graphite down at 0.1 to 0.2 is the coverage. We're only covering 15% of the graphite, 20% of cobalt, a little over 20% of vanadium, nickel's at 30%, a little over. Over 50% is lithium. Copper, just above that, is 60%. Rare earth elements is up there at maybe 80%. Molybdenum, silicon, silver up at 85%. Zinc, chromium, manganese, and lead. Greater supply shortages as this ratio coverage is less. So we're going into this market and we've got no investment going into oil, which is going to pose a huge problem in oil. We've got all these mineral shortages that may not work in a metals in a net zero scenario. So I don't know if we have the metals out there for their plan A. So if we're not investing in what currently works, and we can't ramp up what we want to work, what do you think that's going to do? What do you think that's going to do to the energy prices? And I'm going to throw a couple of ideas out there. And obviously, we're already positioned in the channel. If you guys obviously have been listening, uranium is a very, it has a low use of minerals. It has a very high energy dense source. It's emissions free and it's very safe. Yes, it does produce some waste, but it's very small amounts and very containable. So what do you think is going to happen when we go into this future, energy being the most important commodity of any commodity, because that is what allows us to do work and to transform natural resources into usable products. That is wealth. The increase of energy is wealth. It increases taxes. It does a whole bunch of really good things. If we get into an energy shortage, what's going to be the most valuable things in this world? It's probably going to be oil, because that is something that we can pump out of the ground and use. Natural gas, I think, will be highly valuable, and obviously something like uranium would do very well. So as we go into these energy shortages, and as we could potentially even hit shortages of electric vehicle inputs, as seen in the metals in this net zero scenario, we may have to burn more oil for longer than what we think, and we could see, I don't know, ludicrous prices maybe. And again, guys, I don't know the future. What I'm doing is I'm positioning for a scenario that could potentially happen, that I'm basically providing this evidence for. So this is evidence for a potential squeeze in energy, a squeeze in the metals prices. And the way that I think that we can play this is buying physical metals like silver and platinum that are used in the transition, and buying other things like energy directly in some of the energy producing either energy metals like uranium, copper, and all these other ones that support it, or something like the energy itself, like oil and natural gas. So I just wanted to share this with you guys, show you what the news is out there. Give me a thumbs up for the content. Put in the comment section what you guys think. I'd like to hear your opinion. And thank you for listening. This is Finding Value.